Hi, thank you very much. Thank you, Andre. So first off, thank you very much for inviting me. I'm very excited to present this paper. This is joint work with Erik, Gilje, and Nick Roussanov at Wharton, and Jerome Taillard, who is at Babson. So the day the WTI died is a dramatic title, but it was a fairly dramatic event. So what was the day the WTI died, right? So this was April 20th, 2020. And so this, I think a lot of people were aware of this at the time. This received a lot of popular press. And so on the afternoon of April 20th, 2020, oil prices started falling. So the main benchmark that kind of received, I think, most of the press is the WTI Cushing. And so we're going to talk a lot about the WTI throughout the presentation, but when people were talking about oil prices going negative on April 20th, the WTI was where, kind of where the action was. And we'll see some pictures of the intraday prices. But at the close of trading on April 20th, the final closing price, the settlement price for the WTI was negative $37. So it fell about, $60 through the day, $55 through the day to close at negative 37. And so when this happened, Erik, Nick, and I have done some work on oil. I've done a lot of work on oil, as has Jerome. This is sort of very interesting, right? So this is a market we care a lot about. This is a market I think a lot about, and sort of something very odd had happened. So when it happened, initially, the thoughts I had were kind of, what the heck, right? Sort of what caused this? And then the second thing was, well, does it really matter? And so the initial thought that I had was, if you know about the WTI futures market, you'll know that the futures trade right month to month, and they kind of roll. So the May delivery future, which was trading on April 20th, was a fairly kind of stale future. It was expiring. It was going to stop trading the next day on April 21st. And in this period of the market, these futures aren't very liquid. So typically, as they get close to expiry, close to delivery of the future, a lot of the traders kind of migrate out into the next one. There's not a lot of volume. There's not a lot of liquidity. And so I sort of thought, this is kind of a quirk, right? Something weird happened in this market. It kind of got jammed up. And there probably weren't that many people trading. I just was not that big of a deal. And so a few days after this happened, I got this picture was sent to me by Erik from a friend of his. So Erik has spent some time working in the oil industry as an analyst before he went back for his PhD. And so he has lots of connections. And so one of his connections sent him this picture. And so this is the Bloomberg terminal on the evening of April 20th. And it's the sort of crude oil spot price function. And it's showing you all of the different spot prices throughout the Americas. And so in particular, what we're looking at here is the spot prices for all of these different grades of oil and geographies of oil market. And what we see is that the negative prices were not just in the WTI, right? So if you look at places like the second one there, the Bakken, that's in North Dakota, the Alaska North Slope went negative. Prices were negative all throughout Texas. Prices went negative in Louisiana, right? This negative price event wasn't just about some kind of quirky thing happening just at WTI. It spread throughout the U.S. Now, it didn't spread everywhere. So if you look at the prices in the top right, the Canadian prices, you'll see those are positive. But we definitely saw negative prices throughout the U.S. So then we started thinking, okay, so kind of what was the big effect? So there's kind of two pieces to this, right? There's what happened, and then there's what were the consequences. And this paper is essentially entirely about the second question. So this paper is entirely about, at the moment, is entirely about kind of what were the consequences of this. We have done actually quite a bit of thinking about what happened. And my goal here is to try to kind of get through the main paper in an hour. And then I have some kind of we have some speculation. We have some simple modeling about what might happen. And I'm going to try to leave the last 15 minutes for that. So big picture kind of motivation here, right? So this paper is really a benchmarking paper. And so what do I mean by that, right? There's a lot of recent literature sort of thinking about the impacts of financial benchmarks, asset pricing benchmarks on the real decisions of firms, right? So Bond, Emmett, and Goldstein have a nice review. Recently, there's been some neat kind of theoretical work. Dale Duffy's been a part of a lot of it. There's a Journal of Economic Perspectives, Duffy and Stein, talking about kind of what situations are benchmarks effective, what kinds of things can go wrong. A lot of this discussion has focused on LIBOR, right? So there's obviously these issues with manipulation in LIBOR, and LIBOR is actually now being sort of retired somewhat as a benchmark. But this kind of benchmarking idea shows up in a lot of places. So, right, we see compensation contracts, we see people's compensations tied to stock benchmarks, we see, not just oil, there's other commodities that have these kind of benchmarks. So in February of this year, there was sort of some interesting events happening in power markets in Texas, where people had, the cost of the electricity in their house benchmarked to an index, a local index, and when that index spiked, they had all these issues with what they were paying to buy electricity. So this is kind of an interesting topic in general. Now for us, kind of our big picture research question, right, is again just how do these benchmarks, how do these asset prices affect the real decisions of firms? And so there's kind of two pieces to this. So one is just first off, did this drop, this negative price in the WTI benchmark, did it transmit to actual purchase prices that oil companies receive for their oil? And the answer there is absolutely yes. So we can kind of know that pretty clearly, and I'll show you some evidence about that. But then kind of our follow-on question, which we in some sense think is more interesting, is how did the firms respond to this event after it happened? And so in particular, what I'm going to try to show you, and what a lot of this paper is focused on demonstrating, is we have this event, right? We have this event at the benchmark at Cushing, with sort of the main storage hub in the US, where we typically have all this liquidity, where storage gets essentially completely full, right? So storage gets completely full. Now, what exactly that means is kind of subtle, but basically you have oil coming in, there's no place to put it, and so the price drops. Now, that storage constraint was local to Cushing, right? It wasn't true that there were storage constraints at every other place in the country. So for instance, if you were a producer in North Dakota, there was plenty of storage in North Dakota. So it wasn't like oil was going into this pipeline and the pipeline backed up and it started spewing back out in North Dakota. That's not what happened. What happened was the producers in North Dakota received prices based on the benchmark, which is the WTI. And so even though there was plenty of storage in North Dakota, there was this problem that the risk at the benchmark was transmitted through, the risk at Cushing was transmitted through the benchmark to the producers in North Dakota. And so that's going to be kind of the main flavor of the paper. We're going to try to show you that, first off, that this mattered to firms, and the second, that they kind of responded to try to manage the benchmark risk by essentially shutting down production, even though the local fundamentals may not have warranted that. So that's kind of the big picture setup. So before I kind of go into the overview of findings, are there any questions?
Not at the moment, but I'm sure they're coming soon.
Yeah, no problem. Okay, so what are kind of the overview of the findings? Now, frankly, this paper, right now, I think it hasn't been, we haven't posted a working paper version. We've sent it to some conferences, and we're really trying to get kind of feedback, overall here. So this is a very good time to get feedback. So any questions you have are wonderful. But right now, our kind of main focus was getting the institutional details nailed down, and our empirics are actually pretty simple, but we think that they are quite interesting. So what are our kind of main findings? So first off, we're going to show you that these oil prices for West Texas Intermediate, the WTI in Cushing, they transmit through this benchmarking across all of these different geographies and types of crude oil in the U.S. And that this is not, this is not a case of it was a physical backup in Cushing that translated into a physical constraint at the other places. This was purely kind of financial transmission. The second thing we're going to show you is that basically firms that had exposure to this benchmark after April 20th, in particular, there was a lot of worry that this event was going to repeat itself in May, so that when May comes around, you're going to have another negative price event. And so in order to mitigate that risk, what these producers did is they essentially shut down their oil wells, right? So we're going to try to sort of show you that firms indexed to the WTI, firms that had benchmarks to the WTI, relative to firms in places that didn't have benchmarks to the WTI, ended up shutting down their oil in May, and they shut it down in kind of a weird way. So typically when you see oil producers shut down wells, they shut down the non-productive wells. We're going to show you that these firms that were benchmarked actually shut down a lot of the really productive wells. And you can think, right, if I've got a well that's just a gusher, it's producing and producing and producing. If the price is just low, well, maybe it's a low marginal cost well. It's sort of, it's a good well to keep running in the case of low prices. If prices are negative, it's a disaster to run, right? Because you've got all of these oil coming out of the ground that you're going to apply these negative prices to, and that's no good. So we're going to kind of show you some evidence on that. And so the main comparisons we're going to be looking at is we're going to look at sort of basically our proxy for firms that are exposed to the benchmark are going to be firms in North Dakota, and I'll show you kind of sort of a little bit about why that is. And we're going to compare them to firms who were producing in other parts of North America that did not have purchase contracts benchmarked to the WTI. And so in particular, our kind of two main kind of counterfactuals are going to be Alberta, so production, in Canada. And the reason that isn't benchmarked to the WTI is that there's been a sort of a big, there's a lot of production up in Alberta, and there's been a big push to actually establish some liquid benchmarks up there, some liquid markets, some liquid spot markets that those companies, those oil producers use as production. The second counterfactual is going to be California. Now, California oil is actually loaded on the ships in California. And so because it's not connected to the pipeline network that goes to Cushing, they don't benchmark to WTI. We're actually trying to figure out exactly how that benchmark works, but it's pretty clear that it is not benchmarked to WTI. So we're going to look at kind of firms in California, firms in Alberta, producers, and how their behavior differed with firms in North Dakota. We're also going to look just within North Dakota and kind of see how the behavior of North Dakota firms was different in April and May. And we're going to show you there's this kind of difference in how they were, what types of wells they were choosing to run. And kind of all of these tests are designed to try to give us a sense of, okay, we see different behavior across firms. Is this really just these firms had different fundamentals, or is it, as we're going to try to convince you, that it was actually because of this risk associated with the WTI benchmark? All right, so what do we see, right? So we're going to see that firms index to WTI. They also we have some data. I'll talk more about the data later on. But we have data in a couple of different formats. So one of the formats is we have monthly production by individual oil wells. So that's going to be some data that we rely on. We also have some data on pipeline flows. Now, pipeline flows data is kind of interesting because it's actually natural gas pipelines. And we'll talk sort of about how you can kind of infer oil production from natural gas pipelines. But the neat thing here is that it's really high frequency. So we have it daily. And what we're going to show you is basically that there's right when the exposure to the benchmark happens, basically because these contracts are calendar contracts. So if you're worried about something happening in May, on April 28th, it doesn't really matter because you're still on this April contract where you're going to get the April average price. In May, you're now going to be suddenly exposed to this benchmark risk, and we'll show you right at May 1st, there was this big drop in production. And then after the May roll, the sort of May 20th went by without any kind of big problem at the benchmark, the production kind of came back. And so this is going to be sort of a we will have both kind of a low frequency measure, a monthly measure, and a high frequency measure that kind of speak to the same idea. So that's going to be the main findings. So before I kind of get into the meat of the presentation, I'll stop again for questions.
Okay. Question number one: these firms have large and complicated hedging operations in place. Any sense how that side was affected by the negative closing prices?
Yeah. So this is a question that I think we are is sort of curious to us too. Now, one answer to this is from a well operator's perspective. The way they kind of hedge their exposure is they sign these, these purchase contracts, which are monthly average purchase contracts. We'll talk more about them, which are indexed to the WTI. Now, our understanding is they don't seem to do things like buy options, right? So one way you could hedge benchmark risk, particularly this type of benchmark risk, is you could just buy you just buy a put option to hedge the downside risk. And so our argument here is that they shut down the wells. Why did they shut down the wells? Why didn't they just financially hedge it? I think is an interesting question, right? So there's some theoretical work about this, right? Sort of about, Rampini has work about kind of collateral constraints. But I think that the simpler answer is, you're running an oil well, kind of the benchmark goes crazy, and you're looking at the month of May, and suppose someone says, we can buy an option on an option on the WTI to protect ourselves from this risk. And you're sort of thinking, okay, how do we do that? What's an option? Whereas, you can just turn the well off, right? And so that, maybe it's not optimal, but maybe if there's frictions, fixed cost to learning about hedging this particular type of risk, that might be that might be sort of a barrier to doing that. But that's a long answer. The short answer is I agree. It seems like you should be able to hedge this stuff using financial contracts. Why are they shutting the wells off? We don't have a guaranteed answer.
Okay, and why is benchmarking done relative to the illiquid expiring contract instead of the more liquid next month that always has positive prices? Also, why nobody uses Brent, which has none of these problems?
Yeah, so they benchmark to the spot price. Now the question is, why don't they benchmark to the futures closing price? I actually don't know. So one of the things about the WTI spot market is, even though it's very important, it's kind of notoriously opaque. So it's very hard to get anyone to talk to you about why they do things the way they do there. At least that's been my experience. So if anybody has an answer to why they benchmark to that physical spot price, I would love to know. But yeah, I agree. It seems like you would benchmark to the more liquid futures contract rather than the physical contract. Now, Brent, on the other hand, is sort of interesting. So Brent, right, there's kind of this, competition among futures benchmarks, global futures benchmarks for oil, and Brent, which is essentially a North Sea seaborne price, is the main competitor to the WTI. What is interesting is there are parts of the U.S., in particular on the East Coast, where any type of oil, contract that is written typically benchmarks to Brent. So if you're writing some kind of purchase contract in New York, those purchase contracts are typically indexed to Brent because that's, the waterborne price is more important. My sense is with this WTI stuff, there's a lot of path dependency that it just, the WTI grew, it was the first major contract. And so it's the way we've always done it. It's not a super satisfying answer, but I agree, right? There's a lot of things. This problem seems like it could have been mitigated at a lot of different points, but wasn't. But we're going to try to show you that it does seem to matter.
Okay, are changes in production easily reversible, or lost production cannot be subsequently recovered?
Yeah, so that's a great question, and that's one of the reasons we haven't actually posted the paper is we're working on that. And so I'm guessing whoever asked this has a familiarity with hoteling models. And so in a hoteling model, you shut down the well for a month. Who cares, right? The oil just sits in the ground, and then you get it out when things are better. Our understanding and the initial data that we have is a lot of these wells in North Dakota, because they've been fracked, if you stop pumping, the pressure keeps falling you pressurize the fracking liquid, you send it down into the shale. If you don't pump, you still lose pressure, right? And so in some sense, it's not clear, I don't have an answer. Is it a total loss? Is it a partial loss? But our sense is that, looking at the data that we have, is that when they come back online, they're not coming back right at their earlier production level. They're actually coming back at a lower production level. And this is one of the things we'd like to do, is to try to come up with a sort of all-in cost to these kind of shutdowns. And that's going to be a first order concern when we do it. But yeah, that's a great question.
I know this paper is on the real side of this effect, but could you please comment a little bit on the role of USO ETF in this event happening in the first place?
Yeah, so I'll punt a little bit on that until the end. So the one thing, so USO had nothing to do with this. So USO rolls out, at least as I understand it. So USO rolls out of this futures contract about 2 weeks before this happened. So USO didn't own any of this, zero. Now, other financial traders may have owned it, and we'll talk about that. But I'm going to try to leave that till the end. I'll try to talk through kind of how the role of financial traders in causing this event. But USO, I don't think, is the one you want to point the finger at.
All right, thank you.
All right, great. Okay, so let's move on. All right, so here's the intraday plot. So this is a plot from basically the evening of April 19th to the evening of April 21st. And the red dot there is the settlement price, the future settlement price for this May delivery contract on April 20th, which is the WTI spot price. It's the price that that ended up sort of going out into all these purchase contracts through the benchmark. And so what you can see, right, is sort of throughout the April, the morning of April 20th, prices were falling, but it really accelerated right at the end. So it really accelerated right at the end. There was a big drop, there was a recovery, there was another big drop. And the prices settled at about their absolute low point. So as soon as the settlement finished, there's still trading going on the Globex platform. Prices began to recover. And what's interesting about this event is that, in fact, even though this is really related to delivery, and so again, I'll talk more about this later, even though this is really related to a physical constraint, if you were a purely financial trader and you sort of were willing to buy at negative 39, you could have exited that position the next day because there was still another day till expiry. The price has actually recovered, and so you could have made $50 $50 a contract, $50 a barrel, right? Each contract is 1,000 barrels. You could have made a lot of money, right? So you would have been taking on the risk of maybe you would have had to take physical delivery. But really, this was it was interesting. It was the day before the expiry, not the day of the expiry. So again, I'm going to leave some of this discussion about kind of what happened to the very end, but this is sort of a very localized event in time, right? It was it came as a sudden drop. We have this huge low price, this negative price that sets the benchmark, and then kind of things go on. But once that benchmark has been set, that benchmark is in all these purchase contracts. So it's going to be it's going to start having kind of percolating out through the industry. Now, the June contract, and this goes back to the question somebody asked before, the June contract, which in some sense at this point is the active contract, so this is by far the most liquid contract on this day, is sort of fine, right? Nothing really happens. I mean, prices are low. Now, what is interesting is that the June contract actually goes through some pretty wild swings on the next day. So on the next day, it starts to look like people are worried, wow, maybe this storage issue is going to rear its head again in a month. And so you start seeing some pretty big price swings the next year, the final expiry day. But again, at the actual event on April 20th, that second June contract looks just fine. It was trading at $20 a barrel. And so again, this goes back, why not benchmark to this? I don't know. That seems like it would be a reasonable thing to do. I'm not sure. I mean, if you were designing the market, there may be an issue, right? Because you need liquidity in the spot market for the futures market to work. But again, the June contract sort of continued on, pretty calmly throughout this event, at least on April 20th. All right. So how does this benchmark enter into purchase contracts? So typically the way this works is if you're running an oil well, say in North Dakota, you have a contract as a producer with a purchaser. And so the way this works is the purchaser, you're going to basically pump oil out of the ground, and you're going to put it in tanks at the well. A purchaser is going to drive up to your tanks with a truck and say, okay, let's pump the well out of your tanks into my truck. We'll count how much we got. And to decide the price for that amount, that oil that you're going to pump into the truck, you don't get some price that's unique to that day. Basically, all the oil that you sell throughout the calendar month, you are going to receive a price that is based on the average price of the benchmark over the entire calendar month. So if you sold, say, so the purchaser drove up to your well on May 5th, pumped out 180 barrels of oil, what you are going to receive in terms of revenue is that 180 times the average daily price in May, and you're going to get that, sometime in June when you kind of settle up. And so this meant that because a lot of these purchasers were benchmarked to the WTI, they received essentially negative prices, not necessarily negative prices, but the negative prices entered into the average, which meant that they essentially oil, 1/30th, you could think 1/30th of the oil sold in the month of April received that negative price. And so this actually, pissed off a lot of producers, right? You're thinking, look, I'm out here trying to kind of manage, my oil production. I have an eye on fundamental prices, and then we've got this benchmark that's supposed to be liquid. It goes completely crazy. It has nothing to do with anything near me. This doesn't seem fair, right? And so basically, this has led to some complaints. So this is an excerpt from a letter written by Harold Hamm. Harold Hamm is the sort of very outspoken CEO of Continental Resources, which is a company that basically owns a lot of shale leases, among other things. And so he writes a letter essentially to the I think the Congress saying, the $40 drop in the last 22 minutes with a $25 drop in a 3-minute span before trading is unprecedented and materially impacts the calendar monthly average pricing of the physical barrel, right? So this is saying this drop in prices did impact physical sellers. And so the sanctity and trust in the oil of all commodity futures markets are at issue. we need to do something about this, right? And our understanding is there's a lot of litigation around this, right? So in some sense, it's been frustrating for us because a lot of people are pretty tight-lipped when they want, when we want information about this, because they know there's a lot of potential litigation. Okay, so this is kind of how these purchasing contracts work. And so this, again, I've been talking about everything is benchmarked to the WTI. And so what's interesting, and this was something I actually learned basically through this project, is I had sort of always thought that, yeah, the WTI is the main kind of the most liquid place, and that's why a futures market is there. But in fact, there's all these other spot markets. So I sort of thought when you pulled up a price sheet and looked at other prices, say Louisiana light sweet, or back in Guernsey, or New Mexico sour, what you were seeing was a quoted spot price based on trades that were happening in some other location. So I always sort of thought, okay, maybe in New Mexico, there's some storage hub somewhere and there's a little bit of trading going on, and that little bit of trading sets the price. It turns out that's not really true. So one thing, this is another kind of, this is prepared by Phillips 66. So there's a bunch of companies that report these various benchmarks for different geographies and different grades. This was their report on April 20th. And so, for instance, they're reporting all through April, including April 20th, the prices of WTI, which is the left column. And then they're also reporting, say, New Mexico Intermediate. And so one thing, when you look at this plot, you see, oh gosh, there's all these different prices. Why did all these other prices go negative? It turns out that if you look at this report, every column is a constant differential from WTI. So New Mexico Intermediate in the month of April was literally equal to the WTI on every single day, because that's what it is. It's just the WTI plus 0. Now, some grades are worth more or less than WTI, but the way they handle that is, for instance, the one of the other Texas benchmarks, the All Fields benchmark, is just WTI minus a constant 50 cents. So every day they just subtract 50 cents and then they report the WTI minus 50 cents. That's the Texas price. Louisiana onshore is just every day WTI minus 125. And so this seems completely redundant. And so what's really happening here is there's a very low frequency component, like extremely low frequency. Like, for instance, the Louisiana onshore price has been a constant differential from the WTI for like 3 years. But what these companies are doing is they're calling around to these purchasers and they're saying, roughly what differential are you giving relative to WTI? And then they just say, okay, that's the differential. And then they just use the WTI to generate the high frequency dynamics. Every once in a while, these differentials might change a little bit, but they're not changing day to day, right? So when WTI goes negative, it's not like there's some different, some local spot market in North Dakota that can give you a correct North Dakota price. They're basically just to say, well, WTI is negative, we're going to subtract $3, and that's the North Dakota price, right? So even though it seems that there's lots of other benchmarks for big swath of the country, there's really just one benchmark, and then everything else is just a differential off of the WTI. Okay, so any questions about prices?
Yes. So the other benchmarks are all spread-based. The spreads reflect the cost of transformation through space and time. So it's not surprising that they all drop in unison. If it were possible to move crude on that day from Cushing elsewhere, they would have done it so, right?
Yeah, that's correct. And so again, so let's talk a little bit about this, right? So our understanding, right, and I think I may have a slide a little later, but I'll kind of step on that right now. So our understanding is that if you want to physically move oil in and out of Cushing, you have to, or sort of take delivery, say, of a futures contract, you have to be sort of set up to do it. So you have to either have an allocation on a pipeline or you have to have allocation in the storage at Cushing. And so the anecdote that I think is really telling is one of Erik's old connections from the oil industry. We talked to him, and after he said, look, we had something like 50,000 barrels of empty storage about 45 miles away from Cushing. And we started calling that afternoon saying, hey, can we bring a truck down to take some oil to our storage? And they basically said, no, that's not how this works. No, we will not let you, right? And so basically you have this kind of closed system, at least at a higher frequency, you have this closed system where you can't move oil back and forth. Now, that's sort of the local constraint. The sort of the bigger picture constraint is everything is spread based. I totally agree, right? All of these benchmarks are spread based, but that's sort of a choice, right? So for instance, there are other benchmarks that aren't spread based, right? The Alberta benchmark is not spread based. The Alberta benchmark is based on trades that happen in Alberta, and so I think that it seems like the optimal way to do this, right, would be you would have a really good metric for the actual cost of storage at every given point in the system, and that's the price that people would get. But it seems like you had this one central benchmark, the WTI. It had a storage constraint. The way that benchmark was set up was there wasn't any flexibility, right? There wasn't any way to get oil quickly out of that hub, and so prices started falling. And once you have no place to put the oil, there's sort of no limit to where the prices can fall. And because everything else was spread, that then gets transmitted out into the rest of the system, even if it's not a physical constraint at other places.
Okay, there's one question which probably I could have asked earlier, but still, this looks like an isolated event affecting a particular quote-unquote opaque industry. How do you think about external validity of your results?
Yeah, so I mean, again, I think that if you want to think about it as a case study, I think you can. So the question is, I think it's really about this is questions that people asked earlier, right? Is should you design it this way, right? So it's a sort of a very, one thing is a very big industry, right? So if you think about kind of conservatively how much oil sold at this negative price, like what's 1 day's worth of production that got this price, you're talking about something on the order of probably 5 to 10 million barrels. So, you're talking about a negative $500 million event just in the original sale. Oil production is a few percent of GDP. So it's a big industry in the US. But yeah, if you want to think about it as a case study, sort of, if you're going to have a benchmark based on that's going to give you kind of a liquid financial benchmark for a physically constrained asset, setting it up, so that you have, even if they don't typically bind, you have the possibility of really bad physical constraints at the benchmark is not the right way, to do it. But if you want to think of it as a case study, I think that, I would think it's interesting beyond that, but it is obviously, it's a sort of in-depth examination of one event.
Okay, thank you.
Okay, so here's what oil, kind of the oil pipeline network looks like in the US, right? So this is just a plot of all the major pipelines. This is the triangles are refineries, the blue lines. This is kind of the arterial system of oil in the US. You have a lot of production up in North Dakota. You have a lot of production in Texas. You have some production in California. You have a lot of production up in Alberta, and it all moves to refineries through pipelines and on rail, et cetera. Now, again, Cushing is kind of at the center, right? So the pipeline crossroads of the world. So this is the biggest storage hub in the world, but certainly it's the biggest storage hub in the US. So lots and lots of places to put oil, lots of pipelines meeting. Those pipelines are near refineries. You can have oil coming in, you can have refined products going out. It's just kind of the heart of this system. All right. North Dakota, right, way up here, very far away geographically, but North Dakota, even though, right, again, sort of a storage constraint at Cushing, North Dakota also went negative, right? So even though you're very far away, you're connected through the system of pipelines to Cushing. Therefore, they, either for reasons of history or whatever, they use the WTI as the benchmark for the oil they sell. Michigan, same thing. Michigan is hooked in, to this same network, also benchmarked to WTI. Louisiana, also benchmarked to WTI. Now, Louisiana is interesting because Louisiana is near a bunch of ports that can, use waterborne storage. So even though there was really plenty of storage in some of these places, and in Louisiana there's flex waterborne capacity, the prices still went negative because they were indexed to this benchmark. Colorado, same thing. There's another Mideast Waterborne, again, negative prices because they still use the WTI as the index. So again, this whole kind of area in the center of the country was exposed to this this event at WTI through the benchmarking. So what's the counterfactual, right? So the counterfactual is California. So California, you can't pipe oil over the Rockies, has a separate pricing system, and those prices are not benchmarked to WTI. And so even though the prices were low by historical standards, they did not go negative on this day. Producers in California did not have a negative price enter into this average. All right. So here is the posted prices, kind of the histogram of posted prices for all of the different benchmarks, or a big subset of the benchmarks on April 20th, 2020. And so you can see there's this big cluster of them down in the negative. Those are the benchmarks WTI. There's other ones that also went negative, but not quite as negative. Again, some of these spread-based ones. All of these ones over here on the right are California prices. And we don't have the Alberta prices on here, but they would also be over on the right as well. So this is kind of our setup. Our setup here is that we're going to have this kind of counterfactual, that you have a bunch of producers that are not exposed to this benchmark risk, and you have a bunch of producers that are, and we're going to sort of observe their differences in behavior. All right. So the next thing I want to talk about is kind of the basic fundamentals, right? Because our argument here is that a lot of this effect was related to benchmark risk and not related to some sort of macro fundamental that governed oil prices. And so one kind of natural thing to look at if you want to think about oil market fundamentals, really kind of two things to look at. I mean, I guess there are three pieces to look at. One would be production, but we're also kind of more interested here. We're going to focus on refinery utilization, sort of demand, how much oil were refineries using to produce finished goods. And we're also obviously going to focus on storage, because storage, I think, was the main constraint that led to these negative prices. And so you can see this period, right, of March to April. Obviously, this is kind of the beginning of COVID. Lots of things are happening, but one of the things that's happening is throughout the country, refineries are essentially throttling way back. Now, why are refineries throttling way back? Because demand has cratered for refined gasoline, basically, right? And so, one of the kind of things if you're sort of familiar with oil, you probably know this, but if you're kind of a casual observer of the oil market, you may not, is that in the US, about 65% of oil usage is households driving their cars. And so really this drop in people driving everywhere led to a drop in demand, led to a drop in refinery, and this was universal across the entire country. And in particular, the drop, so if you look at the yellow dotted line, the drop was even more pronounced on the West Coast. So in some sense, California had the biggest drop in demand. Makes sense, because they had sort of an initial impact of COVID. There's a lot of driving there to begin with, and so really this fundamental wasn't, the fundamental drop in demand was not unique to Cushing. All right, any questions about this? I saw some pops in the chat, so I'll take a pause here.
Yes. So there's a clarification question. Is there a difference between benchmark risk and settlement risk for these purchase contracts?
So when I say benchmark risk, I essentially mean, so settlement risk would be, I would think about this as sort of, what does the price settle at in the financial market? When I say benchmark risk, I mean, you are a producer at a different location and you have benchmarked to the WTI. So now you are, even no matter what the fundamentals are at your local geography, you are now exposed to WTI. So that's all I mean when I mean benchmark risk.
Okay, thank you.
Okay, so this is the demand side of it, right? So demand cratered. This is something I think we all kind of realized. Oil prices dropped, but in some sense, right? That was a kind of a universal, at least across the U.S. That was sort of a very consistent pattern. And so the second was storage. And now storage, again, right? Storage is a very geographically diverse, measure in the U.S. Right? There's lots of different places you can store oil, and the Energy Information Association, the EIA, will report storage at various different geographies. They report it weekly. And so what you're looking at here is a graph of storage utilization. So how much of the tanks were full at various parts of the U.S. So what do you see? So you see the big drop, or excuse me, the big rise in storage in Cushing. So Cushing got very full very fast, but the absolute level of utilization, rose up to about what it was in California. So California had very high utilization as well. So if you think about kind of fundamentals, you have very sort of constrained storage at Cushing. You have pretty constrained storage in California. In the rest of the US, storage was sort of at a normal level, right? About 60% of storage was utilized in the rest of the US. So if you think about the storage constraint, there's a case to be made there was constrained storage in California. Storage became very quickly constrained in Cushing. It didn't go to 100, but again, you know, the sort of capacity here is a little bit gray, because a lot of times the rest of the storage has already been contracted, so that there's actually, it can't be used because it's already been sold. But this kind of storage constraint was not happening in the rest of the central part of the country. So the rest of the part of the country, in North Dakota, in Michigan, and all these places, there really was plenty of places to put oil. So the reason those oil places got negative prices was again due to the benchmark. So one other kind of interesting measure of storage is that actually in some places, right, you can just put oil onto ships. There's sort of waterborne storage. And so this is a price of waterborne storage. This is the Baltic Dirty Tanker Index. So this is the price to put oil on, you know, on a ship. And so the price here was high in April, but it was not outrageously high, right? So storage was, you know, was constrained, but not in some sort of historic way. And, you know, storage had been constrained in the past. I mean, as recently as December on this plot, it had been pretty constrained, at least in terms of waterborne capacity. And obviously you had never seen anything like negative prices previously. So this is, you know, to us at least, this is really kind of a localized event at Cushing. Now, any other questions? So that's, I think, the last one.
If it's not settlement risk, how should I think about benchmark risk? Is it uncertainty in the value of the hedging contract, or is it future hedging uncertainty?
So yeah, maybe the next slide will help on this, right? So our point here is, so this happened in April, right? So April 20th, this happened. The cat's out of the bag. It's happened once. Now there's a question. So again, I think I understand your question. So one way we're thinking about the risk that the producers are facing, you could call it settlement risk for the May contract. So they're scared that the May contract is going to have the same issue. And sort of one way you can see this is you can actually look at options prices. Now, again, we don't have a great story about why a producer wouldn't just use these option prices. But if you look at these option markets, you see kind of something very striking, right? So what happens? April 20th, we get this negative price event. And suddenly pops into the being all of this trading in puts on the WTI at incredibly low strike prices, including $2, $1, $0. There's trades taking at negative strike prices. And those prices are not zero, right? So this was the price of a put with a $2 strike. For the June contract is the green line. So on April 20th, after the negative price event, the price of that $2 strike put on the WTI spikes to almost $2, right? And so I think what you can think about the worry here is, okay, if we run into this, I think, you know, from whoever asked the question, call it settlement risk. If we run into this problem of physically settling this future next month, prices go negative again. I mean, to me, once prices go to negative 38, there's no reason they can't go to negative 300, right? I mean, once you're on this sort of this inelastic supply of storage, once you're down on that portion of the curve, you know, who knows where prices can go. And it does seem like financial markets were, you know, worried about this, right? That you have this possibility that you're going to have, call it settlement risk, that's going to then transmit through the benchmark. And everyone is worried about this, most notably probably the producers. And so you can see this green line, the May contract, that settlement risk, call it, stays quite high. May 1st, things start looking a little better, kind of the storage starts freeing up. By the time the May contract settles, there's no issue, it settles just fine. So that contract dies, goes to zero. There's still some kind of residual risk in the July contract, but then, you know, this becomes kind of a non-issue. And so, you know, again, this is the sort of evidence, right, that after the original event, people's eyes immediately turned to the next settlement, asking, oh my gosh, is this going to happen again? How do we manage this risk? And so, yeah, I think I misunderstood your question initially, but that's exactly how I would think about it. And then again, just for comparison, it's a stupid graph, but what was going on in Brent? Nothing, right? Nobody cares about a $2 strike price in Brent because there wasn't this issue of potentially having a problem with settlement.
One more question here. Is the fundamental problem in this setting benchmarking or simply a logistical issue? Producers were not sure about the state of storage and had to suspend production until the storage picture is clear.
Right, but so I agree. I agree with that. But what's interesting is that producers in North Dakota, even though there was plenty of storage in North Dakota, were concerned about storage in Oklahoma, right? And so why? Well, because they had benchmarked to the Oklahoma price because they were relying on that benchmark, right? And that's, so yeah, it's true, right, that physical conditions were causing this risk. But what was interesting, right, is you have a market that's supposed to be kind of this liquid market that's sort of reflecting the big picture fundamentals. And sometimes the whole point of benchmarking to the WTI is to not have to put up with local constraints. But the problem is that the WTI was set up in a way that it ran into local constraints, and suddenly those local constraints feed out through the rest of the producers through the benchmark. And that's kind of, if every single producer just negotiated their own price based on local storage conditions, this wouldn't be an issue. But because they're relying on this big liquid benchmark, and the liquid benchmark became physically constrained, suddenly you have this bigger problem, right? And that's kind of our point. And honestly, frankly, I don't want to say any more than that. I think that's what happened. We find that very interesting. If I think that it's possible. I mean, you could say the whole thing, right? This is a weird thing that happened. But I think because people use, I guess in some sense it tells you how locked in people are to the benchmark, right? Is that this happened? You could just not stop using you just stop using the benchmark, but that doesn't seem like that's what they did, right? Instead, I'm going to show you. It seems like they altered their production because they were so tied into this benchmark that they thought that was the best way to handle this.
Okay, one more question came up, as you were answering the previous one. So, and we'll take this one and move on. But don't the distorted prices potentially spill out through the network if this leads firms in the network into distress?
Yeah, I think so. I mean, that would be right. So I think that if you were a producer in North Dakota, that's your worry, right? Your worry is that, all right, we got through this month okay, but what if I produce a bunch of oil and the prices go to negative 100 next month and then I go under, right? So how do I mitigate that? Well, I can just stop producing oil until all of this settles down, right? And I think that's sort of that's what we're trying to argue, that there was this transmission. I think you can come up with lots of reasons why a producer would react the way they did due to fixed costs to learning how to use derivative, risks of distress, all this stuff. But that's basically our story.
All right, thank you.
Yeah. This moderation is very helpful. The one problem is with no feedback, you have or at least I have a tendency to monologue, so I apologize if my answers are long-winded. All right, so what is our basic empirical design, right? I mean, like I said, a lot of this paper is really about kind of understanding the institutional details, but we got some regressions to try to show you that places that had benchmarked to the WTI behaved in different ways. In particular, people who were benchmarked to the WTI shut down their wells in a way that isn't necessarily consistent with the fundamentals, refinery and storage that they were facing. All right, so what's kind of our basic setup here? So we have this data on individual well production, so at the operator level in various parts of the country. So in Alberta, in California, in North Dakota is kind of the main places we're going to focus at. We're going to compare essentially for like the first test, wells in North Dakota, which are benchmarked to the WTI, versus wells in Alberta, which are not. And so we're going to run a simple regression. Now, these data come in a monthly format. So all we can see is the total production in the month. And so our dependent variable here is going to be what we call a shut-in, which is essentially, was there zero oil or was there some oil? And so we're going to look at oils that were producing in March and then ask, did they get turned off in April? Did they get turned off in May? And we have a little bit of June in there as well. But basically we're asking, did they get shut off at the sort of after this happened? Now, why is this sort of the right measure? Well, our understanding, or Erik could speak more to this, is basically the decision to operate these wells is just yes or no, right? You can't sort of meter, at least as far as I understand, you can't meter the control, meter the output. You can either turn it off or turn it on. You could also, in theory, store at the wellhead, but I don't think that there's that much storage. So I don't think that these wells are set up in a way that you can just run the well for 2 months and then store at the wellhead. So what we're seeing here is we're going to show you that they actually just turn the well off. And so we have basically our kind of main variable of interest is going to be, do the wells that have the exposure turn off more after the event? And we're going to have a bunch of controls. So we're going to interact post after the negative prices with WTI exposure, which is essentially North Dakota versus the other ones, and that's basically going to give us kind of a diff and diff, and we'll look at a couple different versions. We'll look at across, Alberta versus North Dakota, and we'll also look at North Dakota, April and May to see how the behavior changes. Any questions here for the setup? Okay.
Not.
All right, great. So again, just to sort of reiterate what I've talked a lot about, right? So again, WTI and Bakken is North Dakota, are indexed to WTI, had this benchmark risk. So there's a possibility, call it settlement risk. It's going to settle again in May. Edmonton has its own reasonably liquid spot market. So it does not have stuff up in Alberta is not typically benchmarked to WTI. Brent also not benchmarked to WTI. And so you can see those prices did not go negative. We know from the Brent options that nobody was worried about them going negative, right? So it's really this risk unique to the WTI benchmarks. All right, so what are we looking at here? So this is just sort of we're going to look at some of these pictures. So I'll just sort of explain how these pictures work. So we have production at a given time in a given place, and we can also see, because we can see production, how productive the wells are. And so what we're looking at here is how often wells get shut in. And we're looking back in 2019. So this is sort of this is almost like a parallel trend, but this is like a way before all of this happened. So what would be kind of a typical picture, right? A typical picture would be for a well operating in March, how many of them get turned off in April, May, and June? So looking at this in Alberta, we see that about a little less than 10%. In North Dakota, same thing. And kind of what is the pattern we typically see? We typically see that if you're going to shut in a well, you're more likely to shut in these low productivity wells than a high productivity well, right? The well's not producing that much, just turn it off. And so you see this sort of higher tail over here, and then a pretty flat decision. And I'm not super familiar with the institutional details, but presumably there's some maintenance and things like this, right? So this is kind of the normal picture. Pretty low shut-ins. They don't turn off wells that often. If you're going to turn off a well, you turn off the ones that are producing not very much. All right. Now let's look at March 2020 versus basically April, May, and June 2020. And so what do we see? So we see that in North Dakota, the blue line, we see a much higher amount of shutting in of wells than in Alberta, right? So we're shutting in a lot, and the reason we're shutting in a lot in both places is that the prices are low, and so that's something we're going to have to think a little bit about. But you see that the shut-in, lots of people are turning oil wells off because presumably oil fundamentals are not that great. And again, what we see shut-ins at the low level of at the lowest level. And here we also see kind of, and again, this is sort of, you kind of eyeball this, you say, is that really statistically significant? And so, we'll show you some empirical tests, but we also see that really, if you think about where the difference is, there's difference here at the low end. There's also a lot of difference here at the high end, right? These really productive wells are more likely to get shut in North Dakota than they are in Alberta. So this is going to be the kind of comparison. It's just, basically this plot. Is this statistically significant? Are these shut-ins more likely to happen in Alberta in North Dakota than they are in Alberta? All right. So we're going to run basically kind of a little diff and diff here. So the unit of observation is going to be well I in year T. So we're going to look at a well, and then we're going to ask from spring to 2019. So there's some seasonality in this. So this is why we're kind of comparing back to the same time in the previous year. So relative to spring 2019, look at spring 2020. Did you see more shut-ins in North Dakota relative to a comparison? And we do two comparisons. One is Alberta and one is California. And so what you see is that, again, just like the picture we just saw, that after this negative price event, you tend to see more shut-ins in Alberta in North Dakota relative to Alberta. You also see more shut-ins in North Dakota relative to California. So the same line, the columns 3 and 4, right? So again, looks highly statistically significant. And so this is, I think this is kind of our main takeaway, right? Is that it seems to us, and I'll show you some kind of more pictures to kind of tease this out a little more, but this is kind of our big argument, right? Is that these wells shut down because people were worried about the settlement risk, the benchmark risk in the next year. And so again, how would you interpret this? 17% more wells, or the proportion of wells shut in is 17% higher in North Dakota. It's 42% higher in North Dakota relative to California. And for the North Dakota to California, that's quite interesting, right? Because in California, we had exactly the same, very low demand, very high, very low demand, very high storage utilization. But you see that it wasn't those California wells that were shutting down; it was the North Dakota ones that were shutting down instead. Okay, so this is, and I can, so if you're sort of being skeptical, you say, yeah, but they're different, and they're sort of, you need to control for more things. We try to do some of this. We have some state fixed effects. We have operator fixed effects. I don't know if that really sucks up variation. If you were really worried about kind of a structural difference, we control for productivity. But again, I think this is sort of a first pass, but it's not. It doesn't really kind of show you, I think, speak so much exactly to benchmark risk. It just shows you that this, there was more shutdowns in North Dakota than there were in these other places that didn't have benchmark to the WTI. All right, so how do we think about fundamentals, right? And so if you think about kind of what fundamentals these producers might be concerned about, the obvious one, right, is price. And so it's worth it to sort of ask the question of what was the price at the beginning of the month that would kind of be the signal to the fundamentals that these producers were facing. And so what's interesting, right, is in North Dakota, on April 1st, 2020, so the WTI is trading, so this is about a month before all this happens, the WTI is trading at $8.98, Alberta is trading at $8.33. And so you see what's happening in both of these places in April, is in April, you have both of these places have low price. Both of them are shutting down a reasonable number of wells. In particular, in North Dakota, they're shutting down a lot of these low productivity wells, right? So, we can say this is before all this happens. This is just kind of what the typical response to a low fundamental price would be. All right, and so we contrast that through May, right? And so in May, what do we see? So in May, the back-end on May 1st, so after this negative price event, the back-end prices have adjusted a little bit. So there's sort of a slightly different spread relative to the WTI. The back-end is now actually trading at a higher price than Alberta. So before in April, we had $8.98 and $8.33. So we had quite a low price. By May 1st, the prices have recovered. But what do you see in the back-end? You see a big, still, a lot of wells shutting in. And in particular, you see not this kind of, you don't see this sort of pronounced slope up here. What you see is a much flatter curve. You see that there's sort of across the entire productivity spectrum, the wells are shutting in. So this does not look like just a response to low prices, right? This looks like, because that, you would see this kind of, we'd shut in the low productivity wells. Here we're shutting in across the entire, in May, across the entire spectrum. No. And so again, this is actually, I think, my favorite plot is, so if you think about just looking at within North Dakota, the blue line is, or the blue dots are what North Dakota wells were doing in April when the price was quite low, $9 a barrel. What were they doing? They were shutting in low productivity wells. What was North Dakota producers doing in May? Well, in May, the price had recovered to almost $23 a barrel, but you still see this incredible amount of shut-in behavior. And in particular, you don't see this kind of upward sloping where we're shutting in the low productivity wells. You see this very flat, we're just going to shut in a bunch of wells. And this is a statistically significant difference. So on average, right, they were shutting in more wells in May than in April, even though the price was considerably higher in May, because I think that they were worried about this settlement risk on this benchmark risk on the May contract.
Okay, here's a question. Would it make sense to run a placebo test by comparing Alberta and California?
Yeah, actually, I think that would. That's a good comment. I think we have more testing to do, and sometimes I kind of my ideal test would be some big time series regression where you tried to control for all the reasons that people shut in and tried to sort of calculate an abnormal shut-in. But the data is sort of hard to work with, so we're working towards that, but I'm not even sure if we're going to have enough data to do that effectively. But that's an excellent idea, to look at that. We'd also, I think, like to look at Texas, although they're close enough to the hub that it's hard to disentangle. Is it fundamental or is it transmitting through the benchmark?
Okay, thank you.
All right, and so again, here's the here's another sort of way to do this. You can look at kind of like, was there different behavior April of so this is North Dakota versus Alberta. So was there different behavior April 2019 through April 2020? And so we've seen this in the pictures. Basically, you can see that this is kind of another type of placebo we do. There's no difference April to April. So they have very similar shut-in behavior April to April. Where do you see this real difference? You see this difference after the effect, after May to May. And again, this is a period, right? So North Dakota is shutting in more, even though prices in North Dakota are higher in May than they are in Alberta. No. So, oops. All right. So again, economic interpretation. All right. So I think I'm going to skip this because this is just some parallel trend stuff. And so I want to get to this kind of more high frequency data since we're running a little low on time. And so I think this is neat, right? So through April, right? This happens in April. And then you've got a bunch of days left in April. It's already kind of the cat's out of the bag. And what you're really worried about is this happening again in May. And so what oil is going to be exposed to a May negative price event around the roll of the future is anything that's sold after May 1st, because these things are monthly purchase contracts, right? So in June, you're going to roll. If you're worried about that settlement in June, then anything you sell in May is going to be exposed to that particular risk. And so we want to kind of zoom in and right around this, so there's a big difference between April 30th and May 1st, because April 30th oil is not exposed to this risk, May 1st oil is. And so how can we look at this? So we can look at basically, there's daily data on pipeline flows, and we can look at pipelines in places where most natural gas is actually coming from oil wells. So when you frack a shale oil well, you actually, along with the oil, you produce a large amount of natural gas, and that natural gas goes into the pipeline. You can sell it as well. I mean, it's often not very valuable because natural gas, there's a lot of it in the US, but it is a major source of natural gas. So we look at places where you see natural gas coming mostly from oil wells, we call them associated gas states, versus non-associated gas states. So again, what would a non-associated gas state be? A non-associated gas state would be something like Pennsylvania, right? So in Pennsylvania, most of the fracking is just purely for natural gas that comes out of the wells because people actually went to try to get the natural gas. In North Dakota, natural gas goes into the pipeline because it's a byproduct of producing oil. And so you can look at the natural gas flows in the places where natural gas is coming from oil wells and get a pretty high frequency measure of oil production. And so what do we see? We see that on May 1st, right on May 1st, you see a very large drop in the amount of natural gas coming in the pipeline from places where it's coming from oil events, or from oil wells, right? And so again, this tells you that, if you were just worried about some big picture fundamental, you would just be shutting everything down April 26th, April 27th, they'd be very smooth. But this big drop right at the moment when you roll over into this May 1st, where you're going to be exposed to this possible negative price event in May, gives you, sort of tells you that maybe that's particularly what they were worried about. And again, you can do statistical significance just sort of in an event study. This is a four standard deviation change. And so this to us sort of tells us it's about this roll. And then so you can keep going, right? You can say, well, what about May? So in May, we go through May, the May roll happens, the June contract rolls on May 20th. So that's the circle. And then what happens? Productivity starts to recover, right? So that's basically, that roll is the low point of this production of gas from these oil wells. And then it starts to rise right after. So again, this is consistent to us with what producers were really worried about was, oh gosh, I sell a bunch of oil in May, something crazy happens at WTI, we get a negative 500 price at WTI, and I'm just going to lose all this oil. So I'd rather just shut things down. Okay, we get through May, things look good. Let's start let's start turning the taps back on, right? And so, again, it's hard to assign statistical significance. Only time in the last 3 years when the last 10 days of the month has seen production growth in excess of 5%. It is an unusual pattern to see. And again, we think the timing is consistent with the real focus here being this roll risk happening, the expiry risk happening at the futures contract. All right, so that's basically it. I think I've talked through most of the conclusions, but I'll stop here for questions. I don't know if I'm going to have time to do. Actually, I'll probably have a little time. I can do a little bit of what happened, but I'll take questions on what we have up till now.
Okay, the question that I have in the store is if you would like to comment on what actually happened that caused negative prices on April 20th.
I would love to. This is super fun. So I'll table that. But are there any other questions, or is that it?
I'm not seeing anyone in the queue, but hopefully once you cover this question,
perfect
we're gonna have a few more.
Let's do it. So what happened, right? So this paper is not about what happened, but what happened is super interesting. And we don't know. We may do another paper. We're not really theorists, so I don't know. We're a little bit gun shy on this, but all right. So big picture, what happened, right? So storage utilization was high everywhere, particularly WTI, but had been at similar levels historically without negative prices, right? So this all comes down to, I think, a storage constraint, but it's kind of an interesting one, right? It seems like there was more places to put it, but you kind of need a storage constraint, right, to get negative prices. So the other kind of part that was in the mix here was there is evidence that there were financial traders who were unable to take the delivery of oil, who were exiting their position around the large intraday price drop. So we actually I've done some microstructure work in this market, so I have the order book for traded settlement contracts. You can see that there is really abnormally, so a traded settlement contract is a sale you make in the middle of the day or anywhere during the trading day that says, I'm just willing to take whatever the price settles at, just get me out of this position, basically. I don't need to get the price right now, I'll take the settlement price. And there was huge selling volume. So basically, people willing to sell oil at a difference below that settlement price throughout the day in a completely unprecedented way. So you could see there was sort of people panicking, trying to get out of the market. Now, this is really unusual, as typically financial traders are way out of this contract by now. The US oil ETF rolls 2 weeks prior. Almost, it's just very unusual. I mean, this market is the settlement market, right? This is sort of the physical settlement. You would expect most of the participants in it in the futures market at this point to be people who are going to be willing to take delivery precisely to avoid issues like this, right? So this is kind of why people point at a financial trader as causing this. All right. Now, what is sort of really intriguing? So there's anecdotal evidence that there's this thing called the crude oil treasury product that the Bank of China started offering. And so what was unusual about this? So the Bank of China basically said, okay, if you're a retail investor, you can buy an oil future. We'll buy it for you. But they didn't really hold your hand when you did it. And in fact, you were required on your own to roll out of the contract if you wanted to. So if I owned the May contract, in order to roll into the June contract, I was responsible for selling the May contract as a retail investor and buying the June. If I didn't do that, I would be automatically rolled on the second to last trading day, which is exactly when this happened. So this is anecdotal, but to me is actually quite telling because it's just weird that there would be financial traders in there. So you can imagine if this product kind of blows up in popularity, suddenly you have all these financial traders sitting in this market who aren't able to take delivery at a time when normally there aren't going to be any financial traders. Now, all this is anecdotal because I can't get any data on this, but this would at least be consistent with why there's sort of suddenly a surprising amount of financial traders in this market. So why does this matter, right? So at the end of the day, the only way you can get negative prices in this market should be as if there's a constraint on storage, right? Oil comes to the hub, there's nowhere to put it, nobody wants to buy it, the price falls and falls and falls and falls. So it has to be a physical constraint. And this, I think, is true. So we have anecdotal evidence, right, that there was no place to put storage. We have anecdotal evidence of people trying to drive trucks to the hub. They weren't allowed to. And so the issue was that all of the storage that was available had been contracted and was no longer able to be used. There was just no place to put any oil. And once you're in this situation, the price has no bottom, right? It can just fall and fall and fall. And so if everything is about the physical market, the question is, why does it matter if there were financial traders? They're just a sideshow, right? They get their price, but whatever. In some sense, you have to have a physical constraint to see negative prices. And so the question is, can the financial traders lead to a situation where you have this physical constraint? And this is what we think is what happened. And this is actually consistent with a bunch of recent theoretical work, right? So these theoretical models of financialization of commodities, the big idea is financial traders or uninformed traders or whatever, they buy the future and that drives up the price. Now, as soon as you drive up the price, if everyone's just looking at the price as a signal, that includes producers. And in these models, producers will produce more. So these models tend to be kind of low frequency, right? Is that index investors buy oil, oil goes up, oil producers produce more oil, you end up with this kind of oil glut and things are sort of not at their optimal level. But our view is that same kind of intuition can happen at a much higher frequency. And so for instance, think about the following. One of the sort of interesting things that I think people don't really understand about this event was that not only was there a big drop in the refinery input, there was also a really unusual amount of open interest left in the future at 2 days prior to the contract expiring. So typically these, people are out quite a bit, but there was kind of double the normal amount of open interest in this contract on the night before all of this happened. And so you have this kind of two pieces going on at one level. You have this, there's a lot of people in this contract, sort of an unusual amount. You also have a big drop in the amount of demand, the refinery. Some of this was just macro demand. There was actually some stories that we heard about actual refineries who had allocations at Cushing shutting down because they had COVID outbreaks in the refinery. So maybe even a very localized demand effect. But you've got kind of both of these things happening in the market at once. And so why would this matter? And so suppose you are a producer or a storage operator observing the futures market just prior to expiry. So you're April 19th. And you're looking at the futures market and you're going, gee, there's a lot of people who own this future. And you think, well, maybe things are kind of weird. Prices are kind of low. Maybe just a lot of people want to buy. Maybe there's a lot of refineries who are trying to top off their tanks. Maybe there's a lot of people in storage who want to buy. There's just a lot of oil. A lot of people have physical demand for oil because why would there be financial traders, right? This open interest must tell me that there's a lot of physical demand. And so how do you react to this? Well, financially traders are typically out of this contract and into the next nearest. And so you interpret this as demand from refiners and other storage operators to purchase physical oil. So you would say, all right, I see all this open interest. Must be people want to buy oil. If I'm a producer, sure, I'll ship some oil to the hub. If I'm a storage operator, maybe I've got some additional storage, but it's all contracted up. If I knew there was a big constraint, I could undo that. I could sort of say, okay, let me move some oil around or let me do something that can free up some storage. But you don't bother because you think, there's a lot of demand. And so what happens is that this demand from the financial traders kind of fools producers or physical operators into thinking there's high demand. When does the problem get revealed? The problem gets revealed when those financial traders try to avoid delivery, right? So the financial traders are sitting there. Everyone thinks they're going to take physical delivery because no one knows they're financial traders. There are CFTC reports about who's trading, but they don't come out until the week after. And so you sort of say, oh my gosh, none of these, who are these people? Why are there financial traders here? Oh no, we're in this situation where we have no storage, we have too much oil. These people are all trying to get out. And so this reveals the problem and the prices fall. So that's basically what we think happened. Again, we're not theorists. I actually put together a little model based on Goldstein and Yang that's got the same effect. Basically, you've got sort of a random amount of financial traders, you have a random amount of refinery capacity. And so if you look at this PDF, you have a situation where typically there's plenty of refinery capacity and not very much financial open interest. So this corner is where you typically are. If you get the very unlikely draw where you're down here, where you have very low refinery capacity and you have very high financial open interest, you misinterpret the financial open interest as physical demand. And that leads you to the situation where once the spot market arrives, you go, oh gosh, there's no place to put the oil and the prices drop. So negative oil prices in this model are very rare, but they happen in precisely this event, right? High financial open interest, low refinery capacity, because you get fooled and you don't realize that the physical constraint is on the way. So I'm a little over time, but that's our hypothesis. And so we're trying to write a paper about that. But again, we're not theorists.
All right. Thank you very much.